When the stock market drops, most people panic. They sell off their investments in fear of losing everything. But here's a shocking truth. Most millionaires rarely panic during these downturns. In fact, studies show that over 70% of wealthy individuals actually buy more when the market is down. Why is that? How do the rich stay calm when everyone else is losing their heads? The answer is simple. They have learned to think differently. While the average investor is swayed by fear, millionaires have a strategy that keeps them steady during times of uncertainty. In this video, we'll dive deep into why millionaires don't freak out during market crashes. We'll reveal their secrets, how they think, what they do, and how they use downturns to their advantage. If you've ever wondered how the rich stay so cool, even when the market is falling apart, this video is for you. Stay tuned for insights that could change the way you approach your own money. Chapter 1. The DNA of Calm. Why rich people don't panic. The first thing you need to understand is that millionaires have a different mindset. They view market downturns as temporary setbacks, not disasters. A 2021 study by Bank of America found that 69% of high net worth individuals, HNWIs, prefer to buy during market dips instead of selling. Why? Because they know that panic is a reaction, not a strategy. They have a built-in calmness because they've learned how to think long-term. In their world, a bad market year is just one blip on the radar of a 20-plus year financial journey. It's also about emotional control. Rich people are not driven by short-term fear or greed. In fact, successful investors like Warren Buffett have famously said, "Be fearful when others are greedy and greedy when others are fearful." This simple advice keeps millionaires from making hasty decisions. Instead of stressing about the current state of the market, they focus on the future. Chapter 2. Born into strategy. Wealth is inherited, but it's also built. While it's true that many millionaires inherit wealth, a significant portion of their fortune comes from the way they've learned to handle money. They understand that wealth isn't just about income, it's about how you manage and grow that income. According to a study by the National Bureau of Economic Research, most self-made millionaires didn't grow up wealthy but developed financial acumen early in life. One key strategy they follow is living below their means. Millionaires don't get carried away with luxury, even though they can afford it. They are disciplined savers and investors. An interesting fact is that 67% of millionaires drive used cars, proving that financial habits trump outward signs of wealth. They know that making sound financial decisions over the years compounds to a greater net worth. Chapter 3. Live above the noise. The art of being detached from short-term chaos. Have you ever noticed how millionaires avoid reacting to news headlines? The truth is, they don't pay much attention to the noise of short-term market swings. Instead, they stay focused on their long-term goals. A study by Fidelity Investments found that investors who stayed in the market through the worst downturns had a return rate of 8% annually over 30 years. This proves that the longer you stay invested, the more you benefit, regardless of the temporary chaos. They don't let fear drive their decisions. During the 2008 financial crisis, many regular investors pulled out of the market at the wrong time. But millionaires, like the founders of Vanguard and other investment firms, kept their money in place, knowing that the market would eventually recover. Their strategy is simple: think decades, not days. If you're finding this helpful, make sure to hit that subscribe button to learn more strategies that can change your financial future. Chapter 4. Learn the rule of patience. Why millionaires see market downturns as opportunities. What's the most important trait of a millionaire investor? Patience. Millionaires see downturns as opportunities, not threats. They understand that during tough times, the market discounts stocks, making it easier to buy assets at lower prices. Take, for example, the 2008 recession. While many investors pulled out of the market, those who remained, such as John Paulson, the hedge fund manager, made billions by betting on the right companies that would bounce back. Research from the Harvard Business Review shows that the best time to buy is often when things seem the bleakest. When everyone else panics, millionaires double down on their research and make strategic investments. Chapter 5. Teach resilience. How the rich build wealth through tough times. Millionaires are great teachers, not just for themselves, but for the next generation. They pass on the invaluable lesson of resilience. They know that the ability to weather the storms of market downturns is what separates the successful from the unsuccessful. In fact, a study by the U.S. Trust found that 55% of wealthy families think that teaching children about financial responsibility is more important than any inheritance. They teach the next generation to handle market volatility with grace and strategy. Resilience doesn't come from avoiding risk but from learning how to manage it. Chapter 6. Think differently. The secret framework of millionaire decision-making. Finally, millionaires think differently. They view the world through a framework of calculated risk. When they make decisions, they ask themselves, how will this affect me in 10 or 20 years? Rather than focusing on the immediate crisis, they plan for long-term outcomes. A key factor in their decision-making is understanding that risks can be mitigated but never fully eliminated. They use diverse strategies like asset allocation and hedging to protect their wealth. Studies show that the wealthiest individuals tend to diversify their investments across multiple industries, minimizing the risk of any one downturn destroying their portfolio. Billionaire investor Ray Dalio, founder of Bridgewater Associates, famously says, "He who is not afraid of the storm will never know the calm." Don't forget to subscribe for more tips on how to think like the wealthy and master your own financial journey. In conclusion, millionaires rarely panic during market downturns because they've cultivated a mindset of patience, resilience, and strategic thinking. They understand that wealth isn't built on emotional reactions, but on a consistent, long-term approach to managing money. The next time the market dips, remember that the rich aren't worried, they're planning their next move.